Hello, Anthony.
Hello, Claudine.
We're here today to talk about cost segregation.
Oh, those words together.
I know. Now, first of all, it's an amazing way to save money.
It's an amazing way to save money, but those two words together I think it's an immediate turnoff.
Cost segregation. Last I heard, it's not
segregation. It's a little dated. It's a little dated, and you're going to get a boycott.
Mm-hmm.
So we don't really want to segregate. That's sort of bad.
Yeah.
So this is it's one of the greatest tax savings that's hiding in plain sight. One of the reasons why it's probably hiding in plain sight is it's got this terrible name.
Can we give it a new name?
Super bonus premium would be
savings.
Something like that. And it's super property savings. So it's really something to do when you have commercial property.
Property can sale.
Beautiful.
Okay. So, we want to start by saying so many people will do things that are maybe a little shady or possibly even illegal to lower their tax liability. Yeah. But there's things like cost segregation that are legitimate and they can be done legally, and it's overlooked.
Yeah, it breaks my heart. I see, people like who wants to write these checks to the IRS? It's really obnoxious when you're investing everything, all your time and energy into doing something, and you manage to have a good year, and then there they are with their hand out, and you can't believe, the size of the check you're writing. Might be more money than you made in all previous years combined, and you're thinking this just can't be right. And so, you're trying to get some advice, and no one's really telling you. It doesn't seem like anyone's really on your side. They're all sort of glad you're paying high taxes. No one's really there to say, hey, here's a great way to put cash in right in your pocket. And that's just where people sort of, they get tempted to say, you know what, I'm just here's my strategy. I just won't report all my income. There it is. There's one. I
made some huge charitable donations.
Just right. Then
huge.
And then phony deductions. And then one thing that I see all the time still is a lot of these claims that there's the foreign asset protection trusts and go offshore and it's an automatic savings. And, I always have to read these things. And I'm reading this. I'm like, wow, this sounds really good. This sounds really good. And it's convincing me. And I know it's complete bullshit. These don't work that way. You really can't get out. It's you can experience a moderate degree of tax savings with an incredible amount of offshore planning.
Compliance work.
So much where it doesn't really make it worth it in most situations. And we have a lot of people who call us, they have a business, say, hey, look, I'm thinking about going to offshore. And sometimes it makes sense. It makes sense when you're going to go offshore anyway. But if you're just going to go offshore for tax purposes, it's not really there, and you really need to be, your business better be doing 40 million in revenue a year, 50 million, where it starts to make sense of all the costs associated with creating that entity offshore and structuring things in a way that's actually going to pass muster.
Now, they're saying the U.S. is like the new tax haven. And with cost segregation, all the information we're going to give you today is found right on irs.gov.
Yeah.
Interesting, only 5% of people that are eligible for this tax break are doing it and doing it correctly.
Yeah.
And it could potentially save you hundreds of thousands of dollars. We even found a few instances where it could save you like $1 million. $1
million pretty easily. Yeah. And it's really, who this applies to is people who have commercial property. Mm-hmm. And really, you really need to start with a property that's worth $1 million or more. That's where it starts to make sense. Underneath that, all the work involved, you're not really going to experience all that much. So but if you have $1 million portfolio of commercial real estate, okay, this should really get your attention. And you might be doing a little bit of it, but unless you have an engineering report that goes with it, you're probably not doing it correctly. And by the way, this is what was rumored why Donald Trump won't release his tax returns. Because he has likely been very aggressive, 100% legally, in his cost segregation with his hotels, because hotels are the perfect place for it. Mm-hmm. Maybe I should explain what it actually is in a little bit too, because I sort of missed that. But Donald Trump has a strategic advantage over his competition because he's doing this in an aggressive way that puts cash right in his pocket. Mm-hmm. So why would you want your competition to know that?
To know about it. Okay, so what is cost segregation? The first thing I found is it says, quote, it is an IRS method of reclassifying components and improvements of commercial and residential real estate. And then I said, what? And you said.
Right. And I'm reading this. It's like, this is how I have been brainwashed a little bit because I'm reading that. It makes total sense to me.
Yeah, and I'm like, what?
It's like, that makes total sense to me. Yeah, that's really what I would describe it as.
Yeah.
They're like, oh, wait, okay, so let me explain it to you how that would mean to someone in the real world. So the IRS has this sort of arbitrary rules out there to say if you have commercial property, depending on what type of property it is, if it's a rental property, that expense for it is something that you can't write it off in 1 year, which is sort of nonsense. Like, wait, I just bought this building and you're saying it's not a business expense. Well, not really, because it's like an investment that you're kind of getting a return on, so you have to capitalize it. But like, well, what do you mean capitalize it? That's not even a word. You're making it up. You're making up this whole thing. Well, Basically what it is, if you have $1 million property, you have to only take a portion of 1/39th of that each year because it's 39-year property. Because somebody just said, well, that property lasts 39 years. And then after that, it's that particular type of property lasts 39 years. Some property lasts the 27 and a half. That I wanted to be there when they're like, well, what do you think? 28 too high, 27 too low.
27 and a half.
Ah, there we go. Excellent work. So some just sat around like, yeah, at that point, that property is no longer worth anything. And because that property is no longer worth anything, now we'll let you write off the expense, because if a property's worth anything, then it's not allowed as an expense.
Okay.
Whatever the reasoning behind that is, and
39.6.
30, sure, something. Oh, 39.6, right.
Another random one.
So that's the problem. So $1 million property, you get 1/39th of it. So you're only writing off something like $20,000 a year, 30, my math's right. So that's really not worth a lot. And so it's like, wait a second, I just wrote a check for $1 million. And you're saying I only can get credit for $20,000 this year? That kind of sounds kind of shitty. It really does. And the other problem too is that $20,000 in 39 years. Well, inflation, it's not going to be worth
$1,000,
right?
Yeah.
Who knows what it's going to be worth? So they sort of get you that way, and this is sort of the downside to investing in commercial real estate. Now, where it gets even worse. Some certain rental property, you could say, yeah, I mean, it's not going to change too much over the time. But can you imagine a hotel, right? Now, if a hotel didn't update in 39 years, so we would be back in 1975. So a hotel as it looked in 1975, well, actually now maybe they would book well. Now now it's, well, look at it. There's cocaine right here at the coffee table. Perfect. That's where hotels constantly have to knock down walls.
Yeah.
They have to knock down stuff. I got to do this whole thing. It's dated. I'm not going to get any people here. It's got to look
Rooms,
fresh.
lobby, pools, restaurants.
Right. The lobbies, they
everything.
put a ton of money into lobbies and just getting the appearance right. So is it really fair that hotels, all these restaurants, and a restaurant, I mean, we see a restaurant go, restaurants knocked down, a new one's built in a matter of days.
Casinos?
Casinos, you gotta constantly update. So, but while you're constantly updating, the tax code is treating you as if you're not. And that's really where this came about. Someone sued the IRS to say, you guys are being incredibly insane here.
Go them.
Yeah. And so they're like, yeah, you're right. This can't be done. Now, this is the thing. They've won. So the IRS puts it on the website, but it's, hiding in plain sight, as in, we're going to call it cost segregation. So you're not understanding, like, this is a huge benefit for you that will put money in your pocket. And so this is sort of how it generally works, is that instead of taking the 39 or 27 and a half year property, you're going to condense that. You're going to condense that depreciation into 5, 7, or 15 year.
Okay.
And the quicker the time, the better. Now, the real benefit for people is that you can go back in time. So that you can amend some past year's returns. So take advantage of some of the cost seg you should have done in the last 3 years, 6 years. Now include this year. Whoa, now it adds up. Now, whoa, holy crap, this is all of a sudden a huge check. The general rule of thumb is when you cost seg and you've been, the business has been around for a while, you will experience about a 10% cash flow upgrade. The 10% of the value of your property, that will be the cash flow.
That's amazing.
So, a $10 million property, you do this, you're going to have $1 million.
Yes. And
Yes.
we're working with a very reputable company that does this.
Yes.
And when we were going back and forth in emails talking about cost segregation, they kept referencing engineers.
Yes.
And again, maybe it was a blonde moment,
Yes.
But I kept going, why are they talking about engineers?
Yeah.
Is that like a fancy new word they're making up for their lawyers or their CPAs?
Yeah. Associate engineer.
Engineers.
Shareholder is what I see.
They
right
literally
now.
use building engineers
Right.
because when you go into these properties, you need someone to look at every single 2x4. If it's 2x4, that's an outside wall, that's going to be longer cost.
Probably.
Right? But then if it's one that's just
a partition wall, like, hey, look, this
need.
might be up, this might be down in a few years. And I think this is the way to look at, this is really the way to think about cost segregation. Go into your building and tell me what's going to be there in 5 years. Tell me what's going to be there in 10 years. Tell me what's going to be there in 20. That's how you have to start thinking about it. Say, this is going to look totally different in 20 years. I need to take this expense much quicker because that's not fair.
Right.
So what they'll look at is like, what is actually structural, what is actually going to be around for a while? Because a lot of stuff is not going to make it 40 years. You can think of, mechanical systems will make it 40 years. Mm-hmm. Your venting systems, they don't make it. Decorative things don't make it. Your landscaping doesn't make it. What makes it? What hotel looks
barely
the same?
made it for you.
Right, yeah.
I barely made it for you.
Everything that eats it up.
So yeah, I'd say another reason a lot of people probably don't use this is A, they don't know it exists.
Yep.
The name is sort of weird.
Yep.
But again, you need someone who's extremely knowledgeable in what can be written off and what can't. And you want someone extremely knowledgeable, like an engineer, because the IRS is not going to fight that. They're going to get the report from an engineer and look at it and go, that looks good. Because what are they going to hire engineers to fight engineers?
Well, and also there's something called, a professional engineer is a license. Mm-hmm. And it's a real thing. And my younger brother, Frank, he's a civil engineer in Vermont. And, it's incredibly rigorous what they have to go through. Engineers impress the hell out of me because it's very difficult. And I always find that when I was doing, back when, I was doing land use appeals and stuff like that, I didn't really like it because I was making, legal arguments and sort of arguments to emotional appeal. Or you're like, this isn't good. You want to have the argument where it doesn't even look like you're arguing. You're just telling the facts as it is. Mm-hmm. And that's what Frank is doing now in Vermont. He does he gets people with properties, hire him to get their property approved. And Vermont is they don't want so much development. So you need someone like that. That's what you need. You don't necessarily need a lawyer. You want someone to say, these are just the facts as they are. Here's everything where it is. Engineers just put a lot of time into things, more time than a lot of other people. And that's why I love this I love cost segregation because it is such a rock solid report that is difficult for an attorney to attack.
Right. And there is something called a cost segregation study that you want to get done first. Let's talk about that in a minute.
Yep.
First, I want to let people know that this applies to newly built and existing buildings. But something you said to me yesterday that sort of blew my mind is this applies to U.S.-owned property, mm-hmm. even if it's overseas. Mm-hmm. So would they have to comply with say it's a building in Germany? Do mm-hmm. they comply with German engineering specs or U.S.?
It would be, your engineering specs are going to be one spec.
Okay.
Just because you're cross border doesn't mean like the nature of something has changed. What people get confused on though is the German rental property. I think there's about a 10-year depreciation. Mm-hmm. So they're wondering, like, do I take that? Can I take that 10-year depreciation schedule for that's in Germany for this property? No. Oh. We don't. The way the U.S. tax code is, we don't care how another country does it. We do it the right way. We're the USA, and our way is the best possible way. They're doing it all wrong. We don't care. The only time a foreign depreciation is going to matter for U.S. tax purposes is when it affects your foreign tax, because your depreciation for your German will affect your German tax.
Yep.
And then your German tax paid will affect your foreign tax credit. That's the only way it applies. Otherwise, we just don't care about that. And so it's sort of a good news, bad news. For a lot of people, they might be watching this and say, what do you mean my foreign real property is reportable to the IRS? I haven't been doing that for a while. Whoa. I might have a problem.
Well, then it's good to do a cost segregation because if you end up owing money, you can sort of balance that with the savings from the cost seg.
Yeah, and that's something that we see with the offshore voluntary disclosure program that the IRS has for people, the more onerous one, that the IRS will actually penalize you on the value of your real property. Well, then you're going to need something to offset that. And this is where cost segregation really comes into play. Like, okay, well, you know what? Bad news, I have this tax bill. Good news is I have a great way to offset it.
Yep.
And then also for people who have been in compliance with their international reporting, which congratulations, you're in rare company. Great news. Let's not forget about it. If your property's worth enough, it's worth to send an engineer over to say, okay, what is this all about? What's here?
That's where the cost segregation study comes in.
That's right.
Because before you take the time to invest, because it is a lot of work, and you probably don't want to do it yourself, I would guess, knowing how IRSGOV, the detailed instructions. You want to have a cost segregation study done. And basically, are they making sure it's worth it for you?
Yeah, that's what they want to make sure. The general rule is at 10%, but no one's going to guarantee you that. Who we work with, we don't guarantee it, even though we try to just give some people a general outline, like what's the upside of it? Well, the potential upside is you might be getting 10%. It happens a lot. And then that's a 10% that now, what's so beautiful about that is that's cash in pocket, which can allow for a future expansion of another one where you're doing an additional cost segregation. And this is what's great. You have to understand in business, if you want a competitive advantage, the best one is to have a better tax strategy than anybody else. If your competitors aren't doing this, you can run right over them.
Yes.
And they're going to wonder, how did this guy doing it? We see what he's charging to rent, or see what they're doing. What's he doing? Well, make sure you don't share your tax returns, and make sure you don't share this video with them, I suppose.
Yeah, I read an interesting book where they say most businesses base their business plans on profits and losses. And a successful business does taxes, profits, losses.
Yeah.
So taxes are the first thing they think about.
If you want to run a business the right way, you actually think about taxes first and then how you structure things around. Instead of trying to work the other way around, which you end up in dead ends because there's things you can't do. That is the way to really make a killing, is look at the taxes first. And that's really, some of the best fund managers, that's what they're thinking about first. How do we deal with the taxes first? If we can't find a good way to deal with taxes, we're not going to do it, because we're going to eat up 50% of whatever we get. That's too much. 50% to throw away. There's just not that enough of good deals that are going to come around again and again, where 50% is just like, you're fine. Oh, sure.
Yeah.
Oh, well, or maybe 60%. And actually, when you add up, if there's a C corporation involved and the personal taxes involved, we could get up to 70% effective tax rate. That's just insane.
All right.
Yeah.
Well, like we said, you can go back years, retroactive, to
Yes.
take advantage of this cost seg. So if you have any questions, you want to know how to do it, who to use, don't hesitate to contact us, info@irs.com. You can like and comment below.
I would just say info@IRSMedic.com.
What did I say?
IRS.com.
It's been a long morning.
Yes.
IRSMedic.com, 888-727-8796. And also subscribe to our channel so you continue to get awesome tax updates. Thanks so much for watching.